So in the PPT, meanwhile, we were discussing about subsequent measurement about convertible instruments, correct? And we should start with financial assets. Okay, fine. First, we'll finish convertible instruments or compound instruments, then financial liabilities part. Okay, those calculations we'll finish, and then we go to this one. What is that? Financial assets, how we are going to do. So financial liabilities and convertible we are going to see now. So test your understanding too. So why I'm taking exam kit as well as this means in exam kit straight away they'll apply all the functions and all the formulas and go. Whereas in TYUs and illustration, they go step by step. So few of the TYUs and illustration I'll be solving to take you to the exam kit. It will be easy. So coming to TYU 2, on 1st April 2007, a company issued $40,001. Okay, $40,001 each. Okay, redeemable preference shares with a coupon rate of 8% at par. They are redeemable at a large premium, which gives them an effective finance cost of 12% per annum. How would these redeemable preference shares appear in the financial statement for the year ending 31st March 2008? Okay, how will it appear? First of all, how will the payment happen? Let us see. This is a redeemable preference share. So redeemable preference share is a financial liability, right? So let us first compute how the payment will work out here. And when the redemption, it's issued on 1st April, and they are asking on 31st 2008, how will it appear? So so we'll take year as usual. First we'll do the workings and then we go ahead. So year, then we'll be having balance brought forward. Then we'll be having finance costs at market rate. 12%, right? Finance cost is market rate, 12%. Then amount paid. Amount paid will be like, what is the interest we are paying?
8%.
8%. And is there anything mentioned that when we are redeeming, any information about it?
No, ma'am.
We don't have any information about it. Okay, so we'll just take this. Just a minute. So amount paid. So I'll be paying at. It's not going to accept. So I'll write this. Okay. It will be paid at 8%. Okay. And then we'll be having closing balance. That is balance CF. Year, since year end is the question, so we'll start from first year end. First year end, actually, yeah, only 1 year, right? So first year end, it will be 2008, 31st March 2008 in the final, and 2009, two they are asking. So we'll put 31st March 2008 and 31st March 2009. So both we'll be doing. And coming to the balance brought forward, initially, how much is the amount the company issued? How much worth of redemption? Yeah.
40,000.
40,000 worth of. It is $1 each. We are not writing the number here. We are writing the dollar value. Okay. So keep that in mind. So 40,000 into 140,000 I've taken. And the finance cost will be for this into 12%. Coming to the amount paid, okay, 12% is the market rate. How much you are paying?
%.
8% only. So it's equal to 40,000 into 8%. 3,200. So what will be the, I just want to make it as minus. I put dollaring. If you notice, I've done dollaring already. So minus 3,200. So my balance figure will be balance brought forward plus 4,800, but you are paying 4,200. Yes, 40,000 plus 4,800 minus 3,200. You see, yeah.
41,000.
Since I've inserted minus symbol, I'll just do some equation here. And the last year's closing will be this year's opening. So I'll map this cell as usual, like the previous problem. So now the interest will be 41,600 into 12%. But how much you are paying? You are paying 3,200 only. That is based on the initial amount. So here it will be 43,332. That's it. Okay. Because they didn't tell when you're going to redeem it. For 2 years, they asked how it will appear. 2 years, I prepared it. So for the 2 years, what and all I have to show. So, so how would these redeemable preference shares appear in financial statement for the year ending 31st March 2008 and 2009? They are asking. So I'll just show the extract. Okay. So first, let me write SOPL within bracket extract. SOPL what and all will be shown here.
Finance.
Which is the finance cost here? Amount paid or at 12%?
At 12%.
At 12%.
At 12% is the finance cost. Okay. Finance cost. Because it includes accruals also. So I'll just put 2018, 35. I think in the exam and all, previous year will come in the next column. So I'll put 2009 first. And then 2008. This is how in the exam, if you see, like this only it will be given. Present year and previous year will be right next column. So here, the present year, I'll be mapping this. For the previous year, I'll be mapping 4,800. Okay, the next is what? This is the extract of SOP. Now I'm going to prepare the extract of SOFP. Coming to SOFP, so I have to show only the non-current liability part. So what is the non-current liability here? In 2009.
Forty-three, 392.
Yes, 43,392. And here, don't confuse with lease. Lease we'll be calculating next year and next year's amount only we'll be taking. Okay, here the year end, that one, how much is the non-current liability we have to take? Closing balance we have to take. Okay, that's it. SOFP, SOPL. Regarding this transaction, you will account for the finance cost and the pending amount. First year, if it is 4,992 means you have to take for that is 2019, 4,992, 43,392. Then coming to 2018, if it is 4,800 you're taking, then 41,600. That year end, how much is due? That will be your non-current liability.
Ma'am, can you just explain once again this difference in this finance cost and coupon rate?
Like, okay, fine. So here, coupon rate is like 8%. They'll always effective finance cost is 12%. The market rate is 12%. Okay. Whereas the company is redeeming at 8% per annum. That is 3,200 they are paying every year. Okay, 8% at par per annum. Okay, 8% only they are paying. If you see the theory part here, I told you I'll refer and let you know. See, the lender in compound instruments, the lender will accept a rate of interest below the market rate for non-convertible instruments. So I said this, I'll refer and let you know. When it is a non-convertible instrument means That is this instrument, particular redeemable preference share is not a convertible one. It is a non-convertible instruments. So here always the lender will accept the rate of interest below the market rate. If you see the market rate is 12%, but you are paying only 8%, 3,200. So, but whenever you're accounting in your finance cost, you as a finance cost, you will take what is the cost incurred as the market rate. You will not see how much you're paying. Why? This is the actual payment, but this 4,800 includes your, see, actually you have to pay 40,000 plus 4,800, but you are paying only 8% per annum. Are you getting? So there is an accrual quotient also here. In our finance cost, we will include the amount to be paid as well as the accrual part. So always we have to take 12% only, not 8% what you have paid. Can you
Okay.
understand this? Okay.
Yes.
In the lease, what is the difference in lease? I'll just show the lease part. You may understand. Here. This in lease, it is different. The balance will be some amount. Yearly, you will be paying like a rental or something 20,000. And in the remaining, you will find finance cost. This is prepaid method. Just a minute, I'll show you. Yeah. The balance will be some amount and there will be only one interest rate. You don't have market interest rate and actual interest rate. You have only one interest rate. And then how much you're paying, the balance will be taking forward. So as only one interest rate is there, this we will be taking for the finance cost. This amount we will be taking for finance cost. But in this problem, you have two types of interest rate. One is market interest rate. Another one is what you are paying. So you have to always show what is the market interest rate in your finance cost, because some amount you paid, some is due. Together we will add and show. Is it clear?
Yes, ma'am.
Okay. So let us go to illustration 3, compound instruments. Convert company issues a convertible loan that pays interest at 2% per annum in arrears. Okay. So we are going to speak about convertible instruments. So illustration 3, convertible instruments will have a liability quotient as well as equity quotient in it, right? So let us see here. So convert company issues a convertible loan that pays interest of 2% per annum in arrears. The market rate is 8%, right? They are paying 2%, but the market rate is 8%, being the interest rate for an equivalent debt without conversion option. So in the market, same kind of loan without having any convertible option, normally it will be float for 8% interest rate, it seems. That's what they're telling. Market rate is 8%. The loan of $5 million is repayable in full after 3 years or convertible to equity. Discount factors are given down. Now, required, what you have to do is split the loan between debt and equity at inception, the beginning, initial, and calculate the finance charge for each year until conversion or redemption. So when they are converting,
3 years.
okay, so
After
first we have to do, they are telling here very clearly, split the loan between debt and equity at inception, that is initial time, how you will do initial recognition, and calculate the finance charge for each year until conversion. So you have to do initial recognition first and then show how it will appear at the end. So let us see the PPT once again and come back. Initial recognition, how will we do? The liability is measured at fair value. Fair value is present value of cash flows. What is present value of cash flows? Every year, how much interest you will pay, how much capital you will pay together. Interest plus capital, that will be discounted at the market rate. Okay, that is, for example, in this problem, if you take what is the interest and capital? Is it given anywhere?
capital is
Hmm.
interest
Loan
2%,
2% of what?
5 million.
5 million. Okay. That is 100.
Market. Oh, sorry.
That is 100. Okay. First year only 100. Second year again only 100. Third year, what you have to do? You have to pay 5 million with that 100. Am I right? Every year you will pay interest. At the end of the year, when you're converting, you will it will be the entire 5 million you have to take. That's what it's mentioned here, no? Interest plus capital.
Yes, ma'am.
I'll show you. We'll see the workings. If you didn't understand, we'll come back. Instead of theoretically speaking a lot. So first, let me go with the initial recognition. So coming to initial recognition, okay, as usual, I'll be taking year, then cash flow. That's what they said, no? Then I have to find present value. Since they have given discount factor, I'll take discount factor. Okay. I'll be having present value. Okay, present value is nothing but cash flow into discount factor. So okay, year 1, 2, 3. How much is the cash flow? Cash flow means here you are paying the interest, right? It is outflow. Here tell me cash outflow, how much it is? Initial time. Let me put few more things here. Certain other informations also I wish to give. How much is the loan amount? Loan is how much?
5 million.
9 million. Okay. Then what is the interest rate you are paying?
2%.
2%. Okay. This 2. Now coming to cash outflow. First year, will you pay 5 million? Repay?
Third year, repay.
Third year only you'll do. So first year, what will you pay? What will you pay?
Interest.
Interest. How much is the interest?
2%.
Percent of 5 million. Okay. 5 million into 2%. So $100,000 is your first year interest. Second year, how much will you pay?
100,000.
Same. 500,000 into 2%. Okay. Third year, what will you pay?
100,000 plus 5 million.
Same.
Exactly. So it's equal to this amount into 2%. Right? 5 million, 100,000 you have to pay. Okay. What is the discount factor for the first year? It is given 0.926. When it is given, you don't do anything. Okay. You just carry on with the given information. 3 decimals they've given. 0.926. Second time it's given 0.857. Third time it's given 0.794. 3 informations are given. What is P value? PV. Present value is what? Is equal to $100,000 into discount factor. Right? So I'll just take the entire value. Okay. So now I have to find what is the debt part. See, why I'm doing this, because they said split the loan between debt and equity at inception. Okay, fine. So let me find this first. How much is the actual value? So sum you have to do is equal to sum of this 3, okay, which is 4,227,700. Okay, but how much is your loan amount, actual loan amount?
5 million.
5 million is your loan amount. So how much is the equity part in this? Find out and all. Tell me what I should do. Loan received is 5 million. I cannot hear.
Ma'am, 5 million minus the PV value, ma'am.
Exactly, 5 million minus the PV value. This is a balancing figure, which is 950. Oh, I subtracted something else. 1 minute. Yes, 444. 772, 300. 772, 300 is your equity value. Let us see the theory once again and come back. You'll understand. Okay, this is what they are. Split the loan between debt and equity at inception. How will you split? Like this. See, liability is measured at fair value. How you measure fair value? Present value of future cash flows at discounted at market rate. This is what I've done. Discounted at market rate. Yes. Yeah. I've taken 2% in the interest. This discount factor is done at market rate. Let us check whether it is at market rate or not. It's equal to 1 divided by, what is a market rate? 1 plus 8%, right? 8%.
8%, ma'am.
Yeah, you're getting that. Correct. So they have discounted at market rate. Okay, and we multiplied it. That's what the theory just mentioned. Present value of future cash flows discounted at market rate of interest. Done. Then equity element is what? How will I find equity? Loan proceeds. In this problem, my loan is 5 million. Okay, 5 million minus how much is the liability element? That is the present value of future cash flows. That is the sum of this 4,227,700. Okay, this is my liability element. If I subtract, I'll be getting my equity element. Just a minute. Hello.
Yes, ma'am.
Some emergency. Can you understand this?
Yes,
Okay.
ma'am.
Yes,
Yes,
this
ma'am.
is based on this theory only. This is the initial recognition. That's what they said. Read line by line, split the loan between debt and equity at inception. Done. And calculate the finance charge for each year under conversion and redemption. At the time of conversion and redemption, how we are going to find the finance charge, finance cost, how much it is, we have to find out. Okay, so now it is a liability. No, so, now I have to go the subsequent measurement. The liability is measured at amortized cost. Amortized cost is nothing but the previously we did know this format, right? This format we are going to do. Can you see this, everyone? Everybody? So this format, I'm going to do it again. How I'll be doing now, let's see. How much is the liability in this problem? Let me draw a line here. In this problem, which is the liability quotient? Out of 5 million, how much is liability?
4,227,700.
Okay, so this is the liability quotient. So for that, I have to, after 3 years, I have to do the redemption, right? So the same step which I followed in this I'm going to do it. Okay, the same thing, because here only we had some redemption and all. After 5 years, the redemption happened. So here after 3 years, if the redemption is happening, means how I'll be doing. Okay. So year as usual, then balance brought forward. Then I'll be having interest, market price. Market price is 8% in this problem. Okay. Then I'll be having the amount paid. In this, are we paying the amount, or we are going to issue the shares? So they are asking here, calculate the finance charge for each year, right? Only the finance charge they are asking. So we are going to do only interest paid. Do this, I'll tell you what is the slight difference here. Interest paid at 2%. And then we'll be having balance carried forward. Okay, coming to year, they've given 1, 2, 3 only, don't bother much. Year end, year beginning, that problem is not there. What is the balancing figure in this case? Which amount will I take it here?
92,600.
What? 92,600?
The sum of the PV.
4227.
Yes, 4227. Okay, this is the amount I'll be taking here. This is what I have as my equity. So for this, how much is the interest? If you see here, I think I'll just expand it a little bit. Okay, interest is at 8%. So is equal to this into 8%. Same step which we did in the beginning. We'll be calculating. And am I paying this 8%? Actually, how much I'm paying every year as interest?
2%.
2% of what? 4.227 or 5 million? How much I'm paying as interest every year?
Or 5 million.
5 million.
For 5 million, for 3 years, I was paying 5 million. So is equal to this amount. I'm dollaring it into 2%. Right? I'm paying this amount. So I'll just put a minus symbol here so that it will be easy. And what is the balancing figure? It's equal to sum of this all. A and B, the first two columns, and second column, I'll subtract it. Right? And this will be my, this will be my next year's opening. So again, I'll be computing 8% on the remaining balance, which is $357,273. So again, I'll be calculating interest paid, which is same 100,000 only. See this cash flow. Okay, this you have to consider. Okay, and here it will be the same value. Same computation. So it is 4,723,189. Okay. Now again, I'll be computing 8%. And again, here, coming here, third year, you will pay interest because you're not paying everything. You pay interest and then you're converting to equity. So here they are asking, calculate the finance charge for each year only. So how much finance charge you're paying on the final year? Finance cost. Third year. Are you paying any finance cost in the third year?
377,855.
How you got that? That is the interest, no? That is the market rate interest. Are you paying at the market rate? Third year, actually, they said you are converting to equity. So third year, what is the finance cost? Only the finance cost. That's why I changed the column as interest paid at 2% instead of amount paid. What will be the finance cost in the third year?
227 into 2%, ma'am.
What? I didn't get you. That is 4,227. That balance into 2%? No.
Yes, ma'am.
No. You just see this column in the initial, how you compute it. In this, how much is the finance cost in the final year, third year? Finance cost means only the interest part. How much is the interest part in the third year?
$100,000.
100 only. It remains the same because they are asking only the finance charge. They didn't ask anything else. So as we have taken rounded off figure, it will come to 5 million only here. But because of rounded off figure, see in the book, they have taken in zeros. They have taken 3 zeros out and everything they've kept in rounded off figure. So it will come to 5 million. 1044 is highly negligible. Okay, is rounded off to 5 million. This is the amount which will be which the company have to repay at the end of the year. That is 5 million they have to repay, and your total finance cost is $300,000 so far. This is what they ask you to show. That is, calculate the finance charge for each year until conversion of redemption. We are converting after the end of 3 years. So till the end of 3 years, you will be paying interest. So $300,000 you are paying as interest. And this actually, if you take, for example, I'll show how it will work here. So instead of all this, if I remove 3 zeros everywhere, the entire problem will change. See, I'll just show you here. Oh, everywhere I have to change. Okay, let me change here and see. Yes. Can you see? 5,001. Actually, I've taken $5,000. 5 million I've taken loan. In the book, they have removed 3 zeros. I think you can find out it's highly negligible. Can you understand the problem?
Ma'am,
Yes.
ma'am, this finance cost is interest only, no? Interest at the rate 8%.
Only interest, because in the question they've asked only that.
But ma'am, you told that 100 is finance cost, something like that you said, no?
Yeah, 100 is the finance cost, no? Okay. See, okay, this is what is actually we paid. Yeah, 338, 357, 378 is the finance cost. You're right. This is the finance cost. Okay, 338, 357 and 378. This is what we'll show in the financial statement. But actual interest paid is 100, 100, 100. So the pending amount still you have to pay 5 million. So they just asked how much will be your finance charge for the year. So we computed. It is interest at 8%, 378. But in that problem,
Ma'am,
it is about non-convertible, no? See, I told about this problem. Can you remember? I was discussing about this problem. This is the finance cost, I said. You are paying so much only, but this is the finance cost, I said. Am I right?
yes, ma'am.
Okay. But this is a non-convertible security. This is a convertible securities. Okay, so which is the finance cost in this? Whether interest paid at 2% or interest at 8%. Interest paid at 8% will be the finance cost. This clarification, we'll see few more problems we'll solve, then we'll get an idea.
Ma'am, but in
Yes.
previous questions, it's directly given that finance cost is this much and this much. But in this question, it is interest charge at 8%. Why is it like that?
See, first I want to tell you one thing. What is a coupon rate?
Ma'am, coupon rate is what the company will pay the interest to the, what do you say?
How much you are repaying? For example, debentures and all will have 10% debentures in the face, in the nominal, what to say, on the face of the name itself, they'll be carrying some percentage. Preference share also normally they'll have 10% preference shares issued at $10 like that they'll give you. So the 10% what is coming with the name itself, we'll call it as coupon rate. That is what you're going to repay. But in the market, the interest rate will fluctuate. Right? It will fluctuate. It may not be the same. See, those who have taken loans 10 years back at some percentage, presently, is that the same percentage prevailing for housing loans? So the market rate, the market interest rate may change. but the coupon rate will remain as such. So coming here in the finance cost in this particular problem, if you see, it is a redeemable preference shares, which is not a convertible security. It is not non-convertible. Okay, so we have taken the as per the theory here. It is mentioned in the previous question. Huh? Yes, it is mentioned here. The lender will accept a rate of interest below the market rate for non-convertible instruments. But as such, I didn't find anything in the split accounting. So I have to check and get you back. So in this, as this is a convertible security, whether interest at 8% is a finance charge or interest paid at 2% is a finance charge. So we can understand this while doing a full-fledged presentation. So if any of the problem, if we are doing SOPL extract and SOP extract, there we can do it. But in your problem, nothing is like that. So we'll solve few more problems, and if you're getting the answer there, it's fine. Otherwise, I'll check still more in the study text and come back to you, right? In this two amount, considering convertible securities, which is the finance cost, whether this or this. This I have to check and let you know. Clear? You want the answer now itself means we'll check the study text right now. Some answer is required. Okay, fine. You will be silent. I'll also be silent. Am I audible?
Yes, ma'am.
I asked, can you want me to check the study text right now, or we proceed with the next problem? Anywhere this SOFP extract is coming, we'll check which they are taking as finance cost. No response means what do you want me to
Check.
do?
We'll check in study text, ma'am.
Yes, we'll do that. 1 minute. Here, this tab is not visible. I'll reshare it once again. And now also it's not coming. Just a minute. So this is financial instruments. We did illustration 3, right? See, I think this paragraph we need to read here. This is regarding financial liabilities. The effective interest will be different to the interest paid if there are additional cost of borrowing, such as redemption premium, issue cost or discount, etc. An example of this type of liability is a deep discount bond. It's a self-study topic. Instrument is issued at a significant discount to its nominal value. Typically, it has a coupon rate of interest much lower than the market rate. The full cost of borrowing is likely to include issue cost, discount on issue, annual interest payments, premium on redemption. The initial carrying amount of the bond will be the net proceeds of the issue. The constant periodic interest, sometimes called as effective rate, can be calculated in the same way. Internal rate of return. IRR you studied, no, in management accounting?
Yes, ma'am.
Okay, like that it will be computed. Effective rate of interest will be given. Okay, FR they have given. Okay, in the problems also we saw. We measured at initial value plus effective interest minus interest paid. This is what we checked. So this is a maximum explanation given regarding this. Let us see anything else is given, because in your exam kit questions, the presentation was not there. Maybe in the TYU 1 or 2 place it might be there. Let's see. So the end of this problem we solved just now, right? So 1,159 every year we paid and balance at the year end, this we computed. So the amount carried forward at each year end, that is 1,041, 1,086, 1,136 this amount and all, represent the amortized cost valuation to be shown in the statement of financial position. This must be shown in the financial position. The carrying amount of the debt amortized cost is the net proceeds plus finance charges recognized in the amount account less. Okay, this is a carrying amount, right? How they got it, they've explained here. Okay. Where is the answer for this question, particular question? Preferentials.
Page 191.
This answer is in page number 191, but without reading theory, how will you go? I know this problem is in 191. I'm just looking for the theory where it will tell anything about, see here, this problem only we did right now, right? Cash flow is given, discount factor is given. And this is the amount we got it. Your question is what? Which is the finance cost? Yes or no? Whether
Yes.
interest or this. How can you get it from the question? It is not explained here. That's the reason I'm reading some theory here. In convertible bonds, this if you read, you may get an idea. May get an idea. No assurance. This is initial, subsequent, this and all we read. This also we read. So here only we have to see convertible bonds. The entity issues a bond that can be converted into shares. Okay. So in exchange of this potential profit, the bondholders normally have to accept a rate of interest below market rate. This is what we'll read this. In exchange of this potential profit, see what they are telling is the bondholder, he will accept the conversion of equity, and after getting the equity, he'll sell the shares at the market rate. Okay, and make a profit. Okay, so in exchange of this potential profit, though, the bondholders normally have to accept a rate of interest below the market rate. Since they are getting a profit that time, so they are accepting a rate less than the market rate, and will have to wait some time before they receive the shares that form a large part of their return. There is also a risk that the entity's share will underperform, making the eventual conversion unattractive. The compound financial instrument must be split into financial. This is a maximum explanation given. After that, they went to the problem. Okay, so any problem which is having financial statement presentation in TYU, you can check that if in case you are accessing through laptop. Any problem having, because we have some TYUs at the end also. If you can find out anything like that, in that any presentation is given, we can get to know what they are trying to tell here. Oh, full-fledged problem is there. Let's see here. TYU 7, if we see, we'll get to know. Just a minute. This we did, TYU 2. This is like the problem which we did. Am I right? Can you see that as they're borrowing 36,000? Finance liability is so much and the remaining is considered as equity. Okay, fine. Which amount they have taken here? Mhm. See here, they have taken this as equity, this as the finance cost. Yes, this is a convertible problem. Are you people there?
Yes, ma'am.
Okay,
Mm.
see
Yes,
here.
ma'am.
See our problem here. Similar. See here. Interest at 8%, interest paid at 2%. Same here. Interest at 9.1%, interest paid at 2%. So, which they have shown, this 2668, this only they have shown at finance cost, not the 720. Yes, Boni, is the doubt clear?
Yes, ma'am. But in the question, it's given no directly that finance
What
cost
is
is
given?
9.1%.
It is
In
not
test,
given as 9. Okay, which is this question? This is question number
test
TY3.
understanding. Yeah.
Yeah, let us see. I think we have that question. We'll be solving next, I guess. TY3 is not there. Okay, fine. I'll take this here. Just a minute. Those who are watching in mobile, close your eyes for a while because it will be paining a lot. TYU3. The entity issues 2% convertible bond. 2% is what? Coupon rate. Am I right? 2% convertible bonds at their nominal value of 36,000. Interest is payable annually in arrears. The bonds are convertible at a time up to maturity into 40 ordinary shares of $100 of a bond. Alternatively, the bonds can be redeemed at par at 3 years. Similar non-convertible bonds would carry at interest rate of 9.1%. What is this? Market rate. Am I right?
Yes, ma'am.
This is a market rate. So they have given 2% as well as 9.1%. So which is your coupon rate? 2% is coupon rate and 9.1% is market rate, no?
Yes, ma'am.
So interest paid is 2%.
Interest paid is 2%, but 9.1% is considered as a finance cost.
Okay.
See, now you've seen the problem. We'll go there and see. They have taken discount factor as 9.1. That's what even we did here. In this problem, which discount factor? Just now I worked and shown, no, 8% only we took it as discount factor. Same here, they have taken market rate as discount factor. That is a formula itself explains that. And coming to finance cost, we will take only this one. 9.1, how much is the actual finance? This is a finance cost. This is the cash paid, amount paid. 720. So better to have here interest of interest paid. I'll write amount paid only to avoid confusion. Yes, Boni, is it clear?
Yes, ma'am.
Okay, but good doubt. Okay, this is done. So, yes,
Equity of 772 will be taken the same for all the years, no, ma'am?
772. This valuation we didn't start yet. I'll tell you how to value this. Maybe after one problem. Slowly we'll go, not in a hurry because a very important chapter. This, yeah. Your question is this 772 will be taken as 772 only. Yes, we'll be taking as 772 only. We will not revalue it.
Okay, ma'am. Thank you.
Yes, that is also given here in the theory. The equity is not remeasured and remains at the same value on the statement of financial position until the debt is redeemed. Once it is redeemed, we have two ways for equity valuation. Either it can go with FVPL, that is fair value of profit or loss, or fair value of OCI. Any one method they can go with. So that we'll be learning in the next class. It's 11:51. I don't want to continue further. So this chapter, we have few problems here. So if we solve this, you'll get a very good idea because all the exam kit problems I picked up here, including constructive base. So you'll get a very good idea you'll be having. So positively by Wednesday, how much ever is possible, we'll try Tuesday. Okay, and on Saturday, Friday also we'll do one more class, and then I'll start with the statement of financial position. That is the second unit I'll be starting with. So for your exam, you're having first unit and second unit. In second unit, already cash flow statement we covered in the first unit itself. But still more for practice only I'll be doing it. Since for midterm, both 1 and 2 will be there. So this one first unit is very lengthy. That's why it took so much time. And more than that, in the syllabus, we don't have revenues. But without revenues, you cannot do your financial statement at all. So I covered that also, which took around 7 classes. So the time, there is some time gap. Whereas third, fourth, fifth, all are this one consolidated financial statement. We can do it. We can save our time there. Okay. So hope you understand today's class. This classification, everything you understood. One thing I want to insist, this interest which is coming here is your finance cost. Fine. This we can make out only by seeing any of the presentation. Otherwise, it's not easy to find out. It's not given anywhere theoretically. Okay. So any doubts you can ask, and meanwhile, I'll stop the recording. If there is any doubt, you can ask.